Hi, I'm TJ Kistner, Chief Investment Officer at Retirement Plan Advisors. Normally I would provide an update on market performance through the most recent quarter end, but given the rapidly changing environment and immense volatility in markets since April 2nd, I will discuss more recent market events and performance through Monday, April 7th. And we acknowledge that markets have seen large moves even after April 7th, but our message to investors is the same. Remain calm and disciplined within your portfolios. Markets around the globe are reeling from the rollout of tariffs on dozens of U.S. trading partners that were much higher than anticipated. U.S. equities have been hit hardest, as the S&P 500 is down 13% year-to-date and almost 18% from its all-time high in February. Growth stocks and the Mag 7 have had it worse, as the Nasdaq is down 23% from its peak in December, and small caps have been hit hardest, down 25% from their highs in November. Somewhat surprisingly, international and emerging markets have fared better than the U.S., and the international index has outperformed the S&P 500 by around 10% so far this year. Some experts claim this is evidence of a regime shift, in which U.S. equities are set to underperform international markets moving forward, which would be a reversal of what we've seen since the global financial crisis in 2008. But we're a bit skeptical, as the impact of tariffs on markets outside the U.S. is equally unknown, and the dispersion in performance may have more to do with the fact that the U.S. market came into this environment with a much higher valuation and very little risk priced in. Core bonds have provided diversification benefits so far this year, as interest rates have fallen amidst economic growth concerns and expectations that the Federal Reserve will need to cut interest rates more than previously thought. The Bloomberg U.S. Aggregate Bond Index is up 3.7%, reflecting a flight to quality as investors seek safer assets. High-yield bonds, however, are down on the year, given the volatility we've seen in equities and other risk markets. We are closely watching the economic data, from unemployment claims, consumer confidence and spending, and business investment, to see if the impact of tariffs is slowing the economy and hurting corporate earnings. Now, as we look ahead, obviously there are still many unknowns with respect to global trade policy and how it will ultimately impact the global economy. That's what's moving markets right now, and we would expect elevated volatility to remain until more clarity is provided on that front. Now, we recognize the periods of volatility and uncertainty can be scary for investors, but it's critically important to take a long-term approach to investing to avoid making bad decisions. Market drawdowns are more common than many people think. Over the last 45 years, the average intra-year drop on the S&P 500 has been 14%. Yet annual returns were positive in 34 of those 45 years, or about 75% of the time. This is why it's important for investors to adhere to long-standing principles such as diversification, risk management, and patience. We remain convicted in the strength of the U.S. and global economy long-term, and will be proactive in identifying opportunities to buy in these down markets. Thank you for listening. We hope you found the information helpful, and remember, the future is better than you think.